So if you're watching this video, then you're probably making north of $400,000 a year and are trying really hard to save for retirement, but are just getting hit with a huge tax bill every year that's really getting in the way of you saving the way you'd like to. If this is you, then you've come to the right video. Because in this video, I'm gonna show you how life insurance and annuity products can do two really valuable things for you in retirement. The first is to increase the amount of money you can safely spend in retirement. We're all worried about not having enough money to spend in retirement, and this often leads us to be more conservative than we need to. Well, life insurance and annuity products were designed to address this exact problem and help you spend more safely by using smart financial planning. The second value that these products can afford you in retirement is to create more after-tax wealth in the later years of your life. Now, you can use this higher after-tax wealth to do a number of things. One is obviously spend more, right? The second is to give more after-tax wealth to your beneficiaries. My name is Rajiv Rebello, and my firm works with high net worth clients like you to create more after-tax wealth so that you can spend in retirement or give to your beneficiaries tax-free by showing you how to properly use life insurance and annuity products in your best interest. I'm an actuary who used to design and price life insurance products for a large life insurance company, so I know exactly how these products work. And if you want to learn how to best use something, it's always best to go to somebody who helped design it. So before I explain how life insurance and annuity products are such great retirement planning tools and how I, in particular, can help you get the maximum value from these products, it's important that I first explain the downsides with the alternatives you're probably looking at the moment. So high net worth individuals like you who are looking to save for retirement are usually stuck between two really bad options. The first is a financial advisor who wants to charge you 1% a year on your assets for the rest of your life. What's even worse about this is if you look into the fine details, it's actually a lot higher than 1%. The true cost, all-in cost of an advisor has been shown to be 1.65%, and that's what you'd be paying every year for the rest of your life. The second option that you have is an insurance agent who's really trying to sell you an insurance or annuity product and is incentivized to sell you a product with a high commission that is not in your best interests. So if you're trying to decide between these two options, you're really in a tough predicament. But the way I'd like you to get to think about this predicament is to think about it like this. Let's say you want to buy a house and you have the choice between two agents. The first agent wants to charge you 1% on the value of the house for as long as you live in the house. Let's call this agent advisor. The second agent is going to charge you 6% of the value of the house, but he's only going to collect it all up front, and then you never have to pay him again. Let's call this agent salesman. Well, which agent should you go with? We're going to evaluate this decision-making process on three criteria. The first is cost. The second is alignment of interest. And the third is value. So now let's start with the first criteria, which is cost. Well, this really should be an easy one because the answer really just depends on how long you're going to stay in the house. Because if you're going to stay in the house for less than 6 years, then it's really the best option to go with the first advisor who's only charging you 1% a year for as long as you stay in the house. However, if you're going to stay in the house for longer than 6 years, then it doesn't really make sense to pay an agent 1% every year. Let's just do a quick math example. Let's assume that you're going to stay in the house for 30 years. Well, if you went with the agent who was charging 1% a year for every year that you were in the house, well, you would end up paying 30% of the original value of the price that you spent on the house. However, if you went with the salesman who was charging 6% of the value of the house, but only doing it one time, you would only pay about 6% of the original price of the house. So from the perspective of cost, in this example, the salesman wins, or the second real estate agent, because you're paying just a one-time commission and staying in the house for a long period of time. So the next criteria we'll evaluate is alignment of interest. Well, This one should also be an easy one. Because if you're trying to buy a house that you're gonna stay in for the longest time possible, then you're better going off with an agent who charges you 1% a year for as long as you stay in the house. And the reason for this is that agent is incentivized for you to stay in that house as long as possible, simply because the longer you stay in that house, the more compensation he gets. Remember that he's earning 1% a year for every year that you're in that house. So he wants to make sure that you find a house that you're gonna stay in for a very long time. On the opposite side, the agent who's only earning a one-time upfront commission doesn't really have a vested interest in you finding the house that's perfect for you. From his perspective, he wants you to buy the most expensive house possible so that he can earn the largest commission possible. So on alignment of interest, the agent who's really charging you 1% a year has the most vested interest, at least from a direct monetary compensation standpoint, from you staying in the house as long as possible. Now, obviously, if you buy a house that's not a good fit, that's a bad reputation for both parties. But from a purely monetary, direct, upfront, initial monetary perspective, the agent who's charging you 1% a year wants you to find a house that you're gonna stay in for as long as possible. So on this criteria of alignment of interest, the agent who's charging you 1% wins. Now let's talk about value. After you buy the house, what is either agent really doing for you? Well, the answer is not much. The agent who is earning 1% a year, of course, is monetarily incentivized for you to stay in that house as long as possible. So he or she is probably going to send you a fancy report every year about the house and how much it's appreciated, and maybe make some referrals to handy people who can help you make some construction changes around the house in hopes that you keep on paying him or her that 1% fee. But the reality is that there's really not a whole lot of value from that report or those referrals, because after all, you can find that same information more on Google or Yelp. And you're gonna get even less value from the agent who already earned his or her payout up front. Because unless you're looking to buy another house, there's no real monetary incentive for that agent or salesman to help you with your current house. So in terms of value, when you're trying to decide between the two, it's really kind of a tie, because you're not getting a whole lot of value from either of them after the sale of the house, right? But if you were to focus on value, what you would want is an agent who's going to charge you an upfront commission, but is going to help you find a house that you're going to stay in for 30 years. And this is exactly how you should be thinking about the advisor that helps you with your retirement goal. Because the truth of the matter is that you're going to be retired for 20 or 30 years. So who is the person and what are the qualities of that person that can help you find the best solution for you that's going to be that best fit for the next 20 or 30 years? Someone charging you 1% a year for the rest of your retirement just isn't cost effective, especially when the all-in cost is really 1.65% a year. And on the opposite side, someone earning a large upfront commission doesn't always have your best interest at heart. This is the basic problem between the financial advisor and the insurance salesman dilemma. Because life insurance and annuity products offer the best retirement solutions possible, particularly for those in high tax brackets. But the problem is that the people selling you those insurance products are not incentivized to sell you the one that is the best fit for you. They are incentivized, monetarily at least, to sell you the one that makes them the highest commission up front. So more likely than not, if an insurance agent is telling you to buy an insurance or an annuity product, he or she is likely trying to get you to buy the one that pays him or her the highest commission, which of course is not always in your best interest. Sometimes it is, as we'll show in later videos, but for the most part, it's not. The problem with the financial advisor, on the other hand, is that he or she is charging you 1% a year and supposed to be acting in your best interest, but they don't even use these products, which are designed for people in high tax brackets who are saving for retirement. And the reason for this is that they don't get to charge their 1% fee on any assets or money that you place into life insurance and annuity products. So they're actively incentivized to not use the solution that is in your best interest. So the people who are supposed to be acting in your best interest, the financial advisor or the fiduciary who's charging 1% a year, is in fact not doing it. So what should someone who is acting in your best interest be providing you with? Well, for starters, they should be providing you with the best solutions for your retirement needs. And that's exactly what me and my firm does. We use our experience in having helped to design life insurance products to show you how to use these products in your best interest. We show you all the benefits and flaws in these products so that you get the maximum value from them. Remember, these products can have serious consequences for people who don't understand them or don't use them properly. And that's what we prevent you from doing, is prevent you from falling into the traps that make life insurance have a bad reputation. Because the truth of the matter is that even though life insurance has a bad reputation, they also have amazing benefits, particularly for people who are saving for retirement and in a high tax bracket. So if you want to get the most value out of a product, you want to go to the people who have designed it so that they can give you the inside information on how to best use it. Because here are some of the benefits that life insurance and annuity products can provide for both current and future retirees. The first is higher pre-tax returns. Often people think that they're getting lower returns by investing in life insurance products. But if you actually compare the bond returns you're getting in your current retirement portfolio with the bond returns in life insurance and annuity products, the returns in life insurance and annuity products are actually higher. And that's because life insurance companies invest in higher yielding long-term bonds instead of lower yielding short-term bonds or intermediate bonds. You're probably saying, well, Rajiv, don't long-term bonds have more risk that come along with these higher returns? And to that, I would say, yes, they do. But the insurance company protects you from this investment risk in exchange for earning a spread on the return. So let's just look at a quick example. Let's say you have the choice between investing in a safe 4% bond or a risky 5% bond. What choice would you make? Well, depending on your risk tolerance, you could go either way. But what if the insurance company said to you that they would invest in the long-term higher yielding bond on your behalf and would take all the risk in exchange for you sharing a percentage of the return with them? Well, then it's kind of an easier decision to make. Because let's say instead of making 5%, they would keep 0.5% of the return and you would get a safe 4.5% return without that same investment risk we were talking about earlier. Well, that's an easy decision because in that case, you are both winning. You are getting a safe 4.5% pre-tax return by investing in bonds through the insurance company, and they are getting 0.5% for taking all the risk. This 4.5% pre-tax return is, of course, higher than the 4% return you would get by investing in shorter-term bonds and trying to avoid that same investment risk. And that's the value proposition of using an insurance company to invest in bonds and create a safer retirement portfolio. You are getting both a higher yield and lower risk, and the insurance company is earning a spread. So the next key benefit that life insurance and annuity products offer is higher after-tax wealth. Well, this is pretty straightforward. If you're getting higher pre-tax returns from investing in bonds through life insurance products, like I talked about in the previous point, and the life insurance company is helping you to save on taxes from those investment returns, then you are creating more after-tax wealth for you and your family. You can use this higher after-tax wealth to either spend more in retirement in your later years or just pass on the extra wealth to your beneficiaries after you pass away. A third benefit that these products can provide you with is lower investment risk and higher guarantees. When you invest on your own, you are responsible for all the investment risk. But when you invest through the insurance company, particularly in bonds for the safety, they are taking on a lot of the investment risk. and providing you with guarantees that you just frankly cannot get elsewhere. You can't invest in the market and ask them to provide you with a guaranteed return. In addition to these guarantees providing peace of mind, they also allow you to take more risk on other parts of your portfolio because you know you have the guarantees to fall back on. It's kind of like investing with a safety net. I am procuring this amount of guaranteed or protected returns so I feel better and more comfortable taking risk. Because if the market fails, I know I can fall back on these guarantees. And that's the key value that these products can provide. A fourth benefit that life insurance and annuity products provide to clients, particularly wealthy clients, are the arbitrage of the benefits that are being distributed. Life insurance and annuity products are designed for wealthy clients. The wealthy clients are the ones who get the best access to advisors, people like us, which help them get the best products and take advantage of all the tax and investing benefits, some of which I've talked about here in this video. A lot of these benefits, unfortunately, come at the expense of less wealthy clients. These less wealthy clients don't have good advisors. So the benefits that would have gone to these clients, these less wealthy clients, go to the wealthy clients instead who do have good advisors. For example, let's say you're looking at a product that provides you with guaranteed lifetime income. Well, if you're wealthy, you tend to be in better health, live longer, and have better access to healthcare. By getting a product that pays you as long as you're alive, you're getting a really high return, but less wealthy people who are not in great health, who buy that same product, are not getting a great return because they don't live as long. In other words, the benefits that would have gone to the less wealthy clients are now going to the wealthy clients who live longer. So it's not really fair that sophisticated wealthy clients get better deals while less wealthy, less sophisticated clients don't. But if I'm working for you, then it's my job to use my life insurance, annuity, wealth management, and estate planning expertise to ensure that you get the best deal possible, simply so that you can benefit from all the tax, investing, estate planning, and longevity benefits that these products provide. So if you're planning for retirement, are in a high tax bracket, and want us to help you, provide you with a solution that gives you and your family higher after-tax income for you to spend in retirement or higher after-tax wealth for you to pass on to your beneficiaries, then reach out to us via the link below and book a free intro call.